2 days that absolutely rocked the precious metals market. We're talking about a sudden, violent, and frankly historic crash that came almost completely out of nowhere. So let's break down exactly what happened. Just look at that number, negative 37%. That was the plunge in the price of silver in a single day. A whole month of just insane record-setting gains, poof, gone, wiped out in a matter of hours. So, that's the big question, right? How on earth does a market that's on fire, one of the strongest rallies we've ever seen, suddenly turn into the steepest, most brutal crash in decades? It's a story about euphoria, a huge policy shock, and a chain reaction that, once it started, nobody could stop. Okay, first, let's just try to wrap our heads around the sheer scale of this collapse. The numbers behind the devastation are, and I'm not exaggerating here, completely unprecedented. Yeah, we're not just talking about a bad day at the office. This was the single largest percentage drop for silver ever, as in a history of recording these things. It completely rewrote the books on market volatility. And look, this wasn't just a silver story. Gold, which we usually think of as the more stable, steady, older brother, it wasn't spared either. Global spot prices for gold fell nearly 9%, and futures contracts got hit even harder, down over 11%. The panic was everywhere. And this table, wow, it just lays out the carnage, doesn't it? On January 29th, silver hits this incredible record high of $120 an ounce. Just 2 days later, it's struggling to stay around 80. That peak spot decline of 37% for silver versus 9% for gold, it really shows you just how brutal this was, specifically for the silver market. But here's the thing you have to understand. This crash didn't just happen in a vacuum. To really get why the fall was so catastrophic, you first have to see the incredible, almost euphoric heights the market had reached right before. January 2026 was just pure market mania. The US dollar was weak, and yet a flood of speculative money pouring in, pushing prices up at this unbelievable rate. It was one of those times where it felt like a party which is never, ever end. I mean, just look at this chart. Gold puts up a really impressive 20% gain in a single month. That's huge. But silver, a staggering 71%. That shows you how much more speculative and, let's be honest, how much more extreme the silver rally was. The market wasn't just hot, it was dangerously, dangerously overbought. So, you know how they say every bubble needs a pin to pop it? Well, in this story, the pin wasn't some complex economic failure or a big global crisis. Nope. It was a single political announcement that changed everything. In an instant. And boom, this was it. This was the bombshell. You see, the market was running on the assumption that things at the US Central Bank would kind of stay the same. But then President Trump nominates this guy, Kevin Warsh, to be the next Fed chair, and it was a complete shock to the system. Okay, so why did this one name cause such an earthquake? Well, it's all about expectations. The market loved the Powell Fed. It was seen as accommodative, keeping interest rates low, the dollar weak, basically perfect weather for a precious metals rally. Warsh, he represented the exact opposite. He was seen as a hawk, a new sheriff in town who's going to come in and prioritize fighting inflation above everything else. So what does hawkish really mean? Well, it means a laser focus on keeping inflation under control. And for the markets, that translates to two things: higher interest rates and a stronger US dollar. And those two things are absolute poison for a precious metals rally. This quote really gets to the heart of it. The very policies that have been acting like rocket fuel for the market's rally, things like quantitative easing, well, those were the exact policies Warsh had been publicly criticizing for more than a decade. The market suddenly woke up and realized the entire game was about to change. So, a single policy announcement spooks the market. But how does that one event trigger such a catastrophic, market-wide chain reaction? Let's break down the mechanics of how the panic actually spread. It was like a line of dominoes just waiting for the first one to get knocked over. The Warsh nomination signals a hawkish Fed. That immediately sends a US dollar soaring. Then, as metal prices dip, traders who'd borrowed a ton of money, what we call leverage, they get these margin calls, which forces them to sell. That selling pushes prices down even more, which triggers more margin calls. It just becomes this vicious, self-reinforcing downward spiral of forced selling in pure panic. Which brings us to a really important question. We saw earlier that silver's crash was way, way worse than gold's. Why? I mean, if the trigger was the same for both metals, why was the outcome so wildly different? Well, for silver, it was a perfect storm. That incredible 71% rally, it was built on way more speculative, borrowed money. Plus, its market is thinner, which basically means there's less trading volume, so big sell orders can crash the price a lot more easily. All this meant that when those margin calls came flooding in, it was the smaller, more highly leveraged silver traders who were forced to sell first and fastest, and that created a tidal wave of selling that gold just didn't experience in the same way. So, after the dust finally settled from this historic 2-day collapse, what happened next? And maybe more importantly, what can we all learn from this whole mess? And here's the kind of crazy part. While the crash was absolutely brutal, it didn't actually wipe out all the progress for the year. After hitting rock bottom, prices found their footing and stabilized. Even after that 37% plunge, silver was still up for the year. It sounds weird, I know, but some analysts didn't see this as a total disaster. They actually called it a healthy reset. The idea here is that the market had just gotten way too speculative, way too leveraged, and this crash, as painful as it was the market's way of cleaning itself out, purging the system to make way for healthier growth. So what are the big takeaways from all this? Well, first, that sentiment is king. In the short term, what people think is going to happen can be way more powerful than what's actually happening. Second, leverage is a double-edged sword. It's fantastic on the way up, but it will absolutely crush you on the way down. And finally, it's a huge reminder. Always pay attention to the Fed. Their policy is one of the most powerful forces in all of finance. And that leaves us with this final, big question to think about. Was the silver crash of 26 just a freak accident, a unique, one-off event born from a perfect storm, or was it a warning shot? A sign that in our modern markets, which are so driven by central bank policy and pure psychology, this kind of wild, extreme volatility is actually the new normal. That's something to chew on.